delving into stocks, property, bonds, economics, and more. This is the Stock Market Mentor podcast. Taking an unconventional stance, we challenge the industry to help you protect your investments and empower you with the knowledge to become a savvy investor. We don't provide financial advice. Here's Steve Moriarty, Tom Hill, and Jacob Sr.
Hey everyone, welcome back to the Stock Market Mentor podcast. I'm back again with my good friend Tom and Steve Moriarty.
Oh, I'm not much of a good friend, obviously.
the slightly worse friend, Steve Moriarty. Look, today we're back and we're back debunking and discussing some topics that have been hard set in stone in the industry for a long time. This topic is that the stock market is not the economy and they're not married together. And I might actually open with a point on Buffett where we'll open with this gentleman and we can discuss 34 years where the Dow just went nowhere. And the economy they increased fourfold, which is already decoupling. And over the next 17 years starting in 1982, where the markets actually boomed and the economy obviously rose, but it was nowhere near the same as the stock market inflation. So I think we might start there and we can start to debunk it from there, Steve.
Yeah, I mean, look, I think it's safe to say I definitely would have thought that there was a stronger correlation between, what the economy's doing and how the stock market's performing. Almost fell off my chair when I looked at China. I mean, it's a good example. It hasn't really gone anywhere for 30 years. But if you look at it, their GDP since 93 has gone up 3,400%, whereas the stock market, the Chinese stock market, has only gone up by about 34%.
Yeah, it's one of those things where you just assume the stock market's connected to the economy, right?
We're doing well, stock market's going to do well.
Yeah, exactly. There's a seminal study on this by a guy called Jay Ritter, and we'll put the paper in the show notes, and it's the link between economic growth and equity returns, right? And so what he did was he actually said, well, how correlated are these things? And what he showed in the paper was there is actually a slight negative correlation. And what he was basically saying was, what happens is, like you were saying, Tom, China's going to boom, let's all pile into China, and the price gets bid up in relation to how good the economy's going to be. So it's a little bit of an expectations game. And this is where we talk about the behavioural stuff, right? Because everybody piles into the latest stock believing that it's going to do really well. No, there's nothing inherently wrong about that. You can be right. But there's a big difference between saying I'm looking for investment returns, and that's a different question to, is economic growth going to be good or bad? Because what you see is, as we show as contrarians, it's actually best time to invest is when the economy is doing really badly, right, during a recession. Why is that? Because everything's cheap, right, generally undervalued. And so this is where I think it's might be Jim Rogers said, Ken Fisher actually said, the way to make money is to know something that not everybody else knows. And that's where you get these problems where everyone says, we're going to all pile into, robotic ETFs. Or, as you said before, Tom, China's really good. Let's all pile into China because it's going to make lots of, it's going to grow for 30 years. But the argument is, well, okay, but is the price sort of correlated to the economic growth rate? And what you find is people overpay based on what they think is coming. And now they may well be correct. I mean, as you said, the Chinese economy has been unbelievable for the last 30 years, but the stock market hasn't been very good at all, right? And so it again ties into what you were saying, Jacob, that point about, the
Buffett.
Yeah. The valuation stuff is absolutely number one critical, right? Because you can, what you were saying, the Dow Jones basically went nowhere when the economy was fantastic, right? Which is a little bit equivalent to what you were saying, Tom, about China, right? And then you get the opposite, where in 1982 you get the best bull market that the US has ever had. The economy does okay, but it's nowhere near what the stock market does. And if you look at the data, there are years when the stock market does badly, when the economy does well, and vice versa, right? And it's really, one of the three themes we talk about is time, and it's really about that. It's just it's a sort of mismatch between time and also expectations.
Yeah. Well, look, just moving on to another point we've got here where time comes into it, and obviously investing is about the short term, but the long term is where we tend to live in today's economy. So we're always talking about where the economy is going to go. And if you asked anybody that didn't really have any real knowledge, and you said, "Oh, how's the economy going in France, for example?" they'd probably pull up a chart of the French index and say, "Oh, it's not going too bad."
Yeah,
and it's not actually how that works. So,
yeah, it's a bit of it's a weird one because it's a disconnect with what you see going on, but also getting back to that point about the price of things. I've heard this so much over my career where people are talking about getting into the latest thing, and as you know, you make money by buying something that's undervalued. If it's out there in the mainstream media, it's too late, right? And this is what happens to a lot of investors at the top of market, right? So if you think about it, let's say you're not interested in stocks at all, right? Let me give you a perfect example. A friend of mine wrote to me about 2 months ago and said, what do you think of Pilbara Minerals? Right now, that's not a recommendation, by the way. But my point being, Pilbara Minerals has already gone up some astronomical amount, right? Now, this person is not interested in investing at all. And what generally happens is, and this is in property markets, in stocks, in all sorts of stuff, people, once it hits mainstream media, then it's generally viewed, a lot more people start to see it. And then a lot more people go, oh, I should think about Pilbara Minerals. It looks like it's easy money. But then the point is you should have bought Pilbara Minerals when it was 10 cents, not $10, right? That's the way you do it. But again, when you look at those things, and this is, lithium's a bit of an example where it's hot at the moment. It's been hot for 12 months. But that doesn't necessarily mean you're going to make a lot more money in it, because lithium's now an essential part of the economy, and therefore, if it's an essential part of the economy, you can make money out of it. But the key is the price of it.
The valuation, yeah.
Yeah.
And I mean, on that point, you raised a really good one there where you said generally when everyone's talking about it, it's overvalued. And I got a good example of this. Yeah. I had a friend who asked me about this, and I gave him the same example. I said, look, when you're hearing about a stock or something to buy from your taxi driver, it's probably too late. And he goes, funny you said that. On the way home on Saturday night, my taxi driver was talking about Bitcoin.
Yeah.
And I think at that point it was within 4% of the top or something. So, my nan, my grandparents, they both started talking to me about trying to invest in cryptocurrency when it was at almost 70,000 Australian dollars for a Bitcoin.
Yeah.
Now I know I'm talking about cryptocurrency here, but it's, the same market psychology applies.
Absolutely.
Market cycles are absolutely key, and that, to your point before, Steve, that markup phase where people start to discuss it amongst themselves, and that sheep effect, the herd effect, where old mate's buying Bitcoin, so I need to as well, or old mate's buying lithium stocks because the Australian economy is doing really well, but by then the price is set in, it's already probably really close to the top, and you should actually start thinking about diversifying into something else.
Because one of the guys in the office made 10 times what they put in,
But
so maybe I should now.
But he didn't tell you that he's been in for 4 years already. or 3 years already.
Yeah. Well, again, it gets back to that point that we always harp on about valuation, right? It's what's the price? That's where you're making money on the disconnect between the price and the value, and what you're looking at is what's going to happen in the future. And if you're buying at as we sort of talk about, if you're buying in a high Cape scenario, what you're doing is saying this really spectacular past is going to continue, right? And what we know is that doesn't happen.
Mm-hmm.
But what happens is you drift into the economy's doing really well, things are booming. But again, that doesn't mean that there's a lot of money to be made. And what most studies show is the reality is you want to look in places where there's not a lot happening, and those places that are really revolting, that's where you want to look for good investments.
Well, it's like Buffett's quote, right?
Yeah.
Sell when others are being greedy, and buy when others are fearful.
Yeah. And so you end up with things such as, I think Professor Bruce Greenwald said, buy things when they're hated. And it's really hard to do. And the reason why is because you can look at things and go, oh, God, who'd want to buy Brazil? It's terrible, right? Mm. But that's exactly the time that you should be looking at it rather than saying, oh, I can't buy Brazil. Why not? Because they're having a recession, right?
Well, that's exactly the time you should be more interested in it. And I mean, let's try and make it real for people now. So most of our listeners will be Australian. So let's talk about the Australian economy, Australian stock market, which has gone nowhere for a few years now.
Yeah, 15 or 16.
Yeah. So what about, how does that, and there might be a question, Steve or Tom, that you guys can answer, how does that reflect? So the Australian economy, to my knowledge, has been pretty good for a long time now with in certain areas, but the stock market's gone sideways.
Yeah, but in 2007, the Cape ratio for Australia was 31, right? So that's, way overvalued.
Yeah.
What we know is this: if anything is really overvalued, that valuation has to become normal, so to speak, right? This is what and my argument about that, Jacob, is this. The reason why the stock market in Australia hasn't done that well is a combination. First of all, point number one, a high Cape ratio in 2007, and we've spent time working that off. Mm. The second part is really important, and we'll touch on this a little bit more, which is what I think has happened is, where's all the money gone? Right? If I said to you, you've got three major asset classes, right? You've got stocks, property, right? So most people have leveraged up not to buy stocks, but to buy property, right? And as you said, Jacob, before, the economy's done all right. But if you have a look at Australia's economy, it's been a little bit boom and bust because we had the mining boom.
Yeah.
But that it sort of serves my point where you look at this, you look at these specific areas of the economy, such as property, and go, things are going fantastic. But it's not going fantastic for all parts of the economy, right? And so, again, you've got to, harp on about valuation, but the main point being, you can't look at an economy and go, oh, well, the stock market's going to do really well there because the economy's doing really well.
Well, that's my point. The economy seems to do well, and that's gone through a hell of a lot through property. So it's just it proves the money flow between stocks, bonds, property, and we've had a really great 10, 15 years in property. And now my question is, that's allowed the stock market, so the PE is currently around 20 to 22, wherever it's at now, over the last 10 years.
Yep.
And so it's allowed that to be worked off. Property is going to do slightly, expected to do slightly worse, and then it might kick into stocks again.
The weight of money argument.
Yeah.
I suspect so. The difficulty with property is that it's not that liquid in terms of getting in and out of. So you've got to, you're a little bit more, and this is in my experience, you're a little bit more bound I mean, you can sell a stock in click. There you go. I've relieved of that stock.
Yeah.
Doing that with property is a lot harder. So it becomes a lot more influential in terms of the economy. But there's a study out. I'll just sort of digress, if I may, for a minute. There's a study out by a guy called Ed Lima, a US economist, and what he talked about was this connection between the housing market and the economy. And basically what he was saying was that if you look at housing approvals, it generally tells you what's going to happen in the economy, right? Which is what we want. We want, tell me what's going to happen and then I'll go and bet on that scenario. And what he basically said was when housing approvals start falling, it denotes a recession, right? So there's a recession coming. That's exactly what's going on at the moment, right? And it's quite simple when you think about it because housing takes a lot of leverage and building, which is economic activity. And if you look at that, you would say at the start that you want to get more and more money into the economy and that will make it boom, right? That's when you want to get in. The problem at the moment is we have exactly the opposite where everybody, and I'm using that liberally, everybody's leveraged up in property. So there's not that many people left that can borrow more money. But the economy is going really well, right? So you're thinking, oh, well, things are going really well and, property prices are rising, blah, blah, blah. But that doesn't mean it's a good opportunity to invest. And the stock market's exactly the same. People get in when the stock market, as you said before, Jacob, it goes up 300%. People go, hey, I thought I should start buying Bitcoin. It's like, dude, you should have bought it 300% ago when nobody wanted it, right? But most people look at the economy to judge whether they should be in stocks.
Why do you think that is? And why do you think there's such a disconnect?
Well, I think there's sort of, if I use this terminology, there's insiders, right, which is people like us who look at the market every day and follow the market, blah, 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 right? Or there's outsiders, which is people who, like my friend, are disinterested, don't really care. Once it comes across their radar, that's when they sort of go, oh, maybe I should start buying stocks, right? But the point being, it only comes across their radar because they're not interested, right? And this is, again, that idea, Tom, about social physics, right, which we sort of touched on in the episode that we did about theory versus reality, right? Because what's happening is you don't pay attention to something until it reaches your view, right? So I can tell you about the daily stock market because I follow the stock market daily, right? Somebody who doesn't follow it daily doesn't know what's going on. When it comes into their line of sight, particularly if it's something about making money, which then appears really easy, right? Oh, you just buy property and it goes up. Oh, well, I should maybe think about buying a property because it'll just go up. That's too late. But what people do is say, oh, well, why would I buy a property? Oh, well, the economy's going really well. Right? So your reference point is the economy in relation to buying a property or buying stocks. That's at a macro level. Nobody ever, well, let me put it to you this way. People who don't follow the stock market don't get into a recession and go, you know what? Bloody great time to be buying stocks, right? Because they look at that, they don't understand how the market ebbs and flows. Whereas if you're, and this is what our purpose is, to educate people to say, look, most of the stuff you hear in the mainstream finance is wrong. Everybody wants a recession. Sorry, I shouldn't say that, but the best time to invest is in a recession, right? When the stock market's awful, the economy's awful. But the point is, it's not about the economy. It's about the price you pay for an asset. And if you pay something really cheap in relation to the value, future value, that's the time to buy it, right? So that's why you see Warren Buffett is buying during recessions, right? Because what he's saying is, listen, this thing's worth $1 and I can get it for 60 cents. Why wouldn't I buy it? Most people are thinking in the here and now, oh, gee, the economy's in recession. That's really risky. But what Buffett's doing is saying, I'm not selling it tomorrow.
Yeah, well, I mean, it brings it back to the statistics lag. So many statistics in the economy, they're all lagging indicators. And that's mainly because we get fed by the media late. And there are very few leading indicators that you can actually look to assess the strength of an economy.
Yeah. Chemicals is a good area. The further you go downstream, let me give a plug for a guy called Paul Hodges, who writes the New Normal newsletter. If you can Google that and follow him, he's an expert in chemicals, and they're good leading indicators, like Ed Lima talked about with the housing approvals.
Yeah.
Right, but it brings up that point, of the stock market is in the future, and like you say, Jacob, most of the economic data that comes out is lagging. This is what our unemployment was 3 months ago. And it's like, well, I want to know what it's going to be for the next 12 months, not the next, not the last 3 months.
Yeah, but then the data that they're feeding is also, we don't know if it's true or false anyway. So there's that many different factors to try and filter through, which I suppose leads us into signal versus noise.
Yeah, and you notice a lot of revisions, like that. It's, a recession, right? 2 quarters negative growth. But by the time they figured out it's 2 quarters of negative growth, you're already in a recession.
Yeah, exactly.
Right? And so again, that's where it becomes important to sort of say, I know what the economy is doing, and I know what the stock market's doing, but it doesn't mean they're strongly correlated, which again is anti-intuitive. Is that a word? Whatever the word is, that they're not that connected. Right, they're non-correlated, if I can put it to you that way. So that's the way you want to look at stocks from a valuation point of view, rather than say, "Oh, the economy's doing really well. Now I'll go and buy stocks."
I think one thing to mention on that note too, if you are going to invest this way and you're looking to buy things when they're undervalued, don't buy and expect to see green straight away. Like very rarely will you get the very bottom.
Absolutely.
So,
absolutely.
If I'm putting money into something, even if I am paying 20 cents and it's worth $1, over the coming couple of months, it might get down to 15 cents.
Yeah, absolutely.
And that it's really hard.
Which is why, again, like we spoke about in the past, it's really important to have a system. It's really important to understand how that money flow is going to work, and to have a sense of asset allocation so you can avoid as much risk as possible.
Yeah, definitely. One alternative, we talked in the last episode about the Kelly criterion, and the reason why I talk about that is because it's a better reflection of reality. And one of the, so what we're saying here is the stock market and the economy are not that correlated, i.e. there's not a connection between them, and it's a little bit deceiving, right? When do you make most of your money? Well, when the economy's in recession. When should you sell? When things are going absolutely gangbusters because of the valuation stuff, right? So one thing I remember, there's a book called A Man for All Markets, which is the autobiography of Ed Thorpe, right? And Ed Thorpe is probably the most famous Kelly criterion investor. Unbelievable guy. We did talk about theory versus reality. Ed Thorpe is probably the most rational guy you could ever.
A robot.
It's unbelievable, right? Ed Thorpe. There's stuff on YouTube about. You can see interviews and stuff, but Ed Thorpe was the sort of guy who said, "Oh, I didn't drive or go and see people during COVID because there was this like really, really tiny probability that I could get COVID, right?" And Ed's a really health fanatic sort of guy. He's 85. He looks like he's about 60, right? So, but what he was basically saying was there was a 1 in, 10,000 chance I'd get COVID. Nah, sorry, too risky, right? And that's where you look at it and go, Jesus, that's the guy who's really serious about his numbers. But my point being, Ed Thorpe wrote a book called A Man for All Markets, right? And it's his life story. What he said in there was, he said, the stock market doesn't really reflect, the economy doesn't really reflect the stock market. And what he said, and this is important on an individual company's level, is he said the fundamentals are actually useless. And by fundamentals, he means things like economic growth, those things that the mainstream look at all the time to tell you about stocks. And Ed Thorpe, who's, this billionaire, basically said, he did all this study and then went, all that stuff, it's basically useless. And it gets back to what you were saying before, Jacob, about the statistics, and it's like a time disconnect.
Yeah.
And that's what I'm trying to say to people is, if you get into the stock market at the top, you don't know it's the top, right? Because you don't know what you're doing. So all of your friends are making money, and then you decide to get in. That's the wrong point, right? But it's overwhelmingly difficult to be contrarian to, as you said, Tom, like Buffett says, well, buy when everybody else is fearful and sell them, when everybody else is greedy. It's quite difficult to do. But what we're trying to do here is we're trying to say to people, look, if you understand how the markets really operate and what the connections really are, you'll do a lot better, right? But that means ignoring the mainstream about a lot of the information that you get out there.
Yeah. Look, Steve, one of the final questions, one of the things I had here that I want to kind of go through, with all these different economic data points being talked about daily, how do investors interpret and weigh these data points to drive better returns for themselves? Like, is there a practical way to navigate through all this information?
Yeah, good question. We talked about that a bit in signals versus noise. And Jacob, you mentioned it before. Once I developed a systematic way to invest, it was so much easier, right? And it was basically because I discovered what worked for me, and that was a good approach. I could make good returns, not all the time, right? But I could invest my money with what I was comfortable with, a level of risk that I was comfortable with, based on what I knew. What I knew was that I shouldn't pay attention to the mainstream because that's not the right information, right? So when you first launch into investing, you tend to follow the mainstream.
Yeah, I agree. I mean, just to add to that point as well on your question, it's so important, and I mentioned this before already, to have that systematized plan, understanding that what your niche is, whether that's looking at an earnings yield, whether that's looking at the Cape ratio, whatever it is, but having a set of filters. So what is the economy actually doing right now? What indicators have I understood that give me that answer? And then how does my plan work within that filter? So have I got the correct risk allocation? Have I got do I understand what the Cape ratio is saying? Where's my entry? Where's my exit? And how do I diversify? If you have those key filters across the board and you have an understanding against signal versus noise, you'll be fine. Because you're not going to be sat in the taxi with old mate telling you to buy Bitcoin. Or you might be, but you say, well, okay, this is a flag for me. I understand.
Bought it 4 years ago.
I understand this is a signal, actually.
Yep.
So I think having a plan is the key point throughout all of this, and understanding that what's been said is actually in there to incentivize the mainstream market.
The thing you want to think about is, as you said, Jacob, getting a system. And what we try to do when we coach people, right, is say to them, here's the principles that you want to work off, which is, we talk about that mean reversion, market cycles, asset allocation, rebalancing, buy low, sell high, personality, right, and that sort of stuff. So in this series, we're talking about financial fibs, which is stuff that's, most people think is true, that's actually not true, right? Together, if you marry those together, what you get to understand is a point of saying, well, there's all this stuff talked about the economy, which is actually not that beneficial as an investor. Warren Buffett says, we don't look at macroeconomics, blah, blah, blah. And so it gets to what you were just talking about, right? Which is you can develop your own system. Once you do that, and if you say, well, I know the economy is not the stock market, I don't need to pay that much attention to the economy, right? And that's what Warren Buffett does. Buffett says, I've got 4 filters. I run it through the filters and away I go. He doesn't say, I'm gonna look at the economy and see what it's doing and blah, blah, blah. He's a little bit of a special case, but what he's saying is, I've got a certain systematic way to invest, and that's what I stick to. What we try and coach people in is saying, and this is what I say basically to everybody, you don't need to invest like me because I'm different from Tom and from you, Jacob. You guys might say, well, Steve, we want to be a little bit spicier. It's like, okay, you can do that. Or we want to be a bit more conservative. But the principles and the financial bullshit that they put out there is where you can say, Jacob, you can do your way, I'll do my way, Tom, you do your way, but we all agree that the stock market's not connected to the economy, right? That's the point we're trying to say. All the things we're talking about in this series are basically saying you can make up your own mind, and what we're trying to do is say, we want to give you the reality of, last time we talked about the efficient market hypothesis, right? And what we say to people is, listen, don't pay attention to that stuff because it's not really true. Here's, an alternative behavioural approach or a Kelly approach, right? And in this one, what we're saying is, don't get too carried away thinking the stock market's the economy or vice versa, because when you look at the data and you look at the results, you get years where the stock market does well and the economy doesn't do well. Why is that? Because it's underpriced. And what you see is the stock market picks up before the economy, right? Because the stock market's in real time and the economy's lagging. Yep. So by the time the recession's over, the stock market's already shifted up.
Yeah, it's moved. And it's, again, it all comes back to that behavioural and psychological, I think, approach. So let's summarise. We're here to demonstrate that there is a range of data and evidence that just supports our central thesis, which is the stock market's not that actually well connected to the economy, albeit thought about by many. And the stock market, and we mean stock market returns, is if you use valuation, you'll probably have better returns than those that are investing according to the economic statistics. So when you're looking at investing, you should consider the predictions of, you can consider the predictions of economists and others who simply just interpret economic data in their belief. Which it's the same as what we do, but we're looking at it from a different perspective. And look, as Peter Lynch said, there are 60,000 economists in the US trying to forecast recessions and interest rates, and if they could do it successfully, they'd all be squillionaires by now. And as far as I know, they're all
still got a job.
They're all still on the news and media telling us what we should buy and sell. So you should largely ignore the daily chatter and think about signal versus noise and start to really look into that. Now, look, if you want to know more about this topic, or in fact any topics that we've spoke about until now, we're actually offering 3 months free to our newsletter, and you can access that through stockmarketmentor.com.au. You just got to pop in your details there. And look, as we've said in the past, please reach out if you have questions. These topics will definitely, or they should, if you're interested in this, spark some questions. And what we're saying is that we're here to answer them for you. So, but until then, we'll see you next time. Gents, anything to add?
No, all good.
Cheers.
Thanks, gents.
That's it for another episode of Stock Market Mentor. We hope you have enjoyed the show, and if you have any questions about the episode or want to discuss how we can help you become a better investor, please feel free to contact us at support@stockmarketmentor.com.au. We'll see you next time.